The notion of tax deferral has long been promoted as the best way to invest for retirement, and intuitively it makes sense. Paying taxes after your money has the chance to grow tax-free, but is that always the best solution? Joining us, Greg DuPont in Dublin, Ohio. Greg, thanks for talking with us today, and you speak frequently about the retirement tax trap. And this is the belief by millions of Americans that they are somehow saving taxes by deferring them. When can that be a flawed strategy?
Well, Scott, the problem with that strategy is it's based upon a mistaken belief that tax rates in the future are likely to be lower for the retiree than they were during their earning years. And there are certain factors at play that make that a fundamentally poor basis to plan on.
So again, this idea is a common theme in defined contribution plans like the 401k. What are some other options?
Well, the basic thought that people need to keep in mind is that with the creation of the 401k, our basic savings philosophy has been shifted from what it was historically. Historically, people would save in combinations of bank accounts, brokerage accounts, all assets that had already been taxed by the government for the most part. And with the 401k and 403bs, now people on autopilot almost put their money into those vehicles and end up losing some of the other tools that were available to them. Not only those tools, but other tools that have been created along the way, such as the Roth investment account and permanent life insurance.
Now, we have to admit that tax deferral isn't always a bad idea. When actually does it make sense?
First of all, it really makes sense if your employer is giving you money to make sure that you get that match. And then if you're young, then it might make sense to continue to front load that particular asset class for a while. But as you get into your earning years, your 40s and 50s, then we need to start thinking twice about whether we want to be putting as much into that bucket. Because the time value of money, the way that that's going to grow, we're just going to increase a problem down the road.
Greg, finally, given the current tax rates and market conditions, if you were rolling over a 401k to an IRA, for example, would you choose a Roth or a traditional IRA right now?
I would take a long, hard look at moving it over to a Roth IRA, depending upon the age. And if you have maybe a Roth 401k available to you at your employer. Because right now we are at historically low tax rates, and incurring a little tax now to avoid a larger tax obligation in the future might make sense for the investor.
That was Greg DuPont in Dublin, Ohio, and you're watching Retirement News Online.